Dig right into the market reaction. We're joined now by Meera Pandit, global market strategist with JP Morgan Asset Management. So the market's, digesting the consumer sentiment number somewhat in stride, kind of more of the same that we've seen for much of this year. From a sentiment standpoint, we've gotten some pretty decent AI indicators over the last few days with the Micron earnings. There's news that OpenAI could be raising at a significantly high valuation of $830 billion, at least that's what they're targeting. How important do you think that theme will be going into 2026?
The theme of our outlook next year is AI lift and economic drift. So you think about some of these consumer sentiment numbers, some of these existing home sale numbers. We may continue to see the data around the economy soften, but the AI trade is still alive and well. And the way we evaluate that AI trade, EVAL, is earnings, valuations, adoption, leverage. From an earnings standpoint, you've seen double-digit earnings growth in the Mag 7 since early 2023. The upward revisions that are going on within those stocks are pretty impressive for 2026 and full year 2025 relative to downward revisions for the rest of the index. And the earnings surprises that you continue to get out of those stocks continue to be well above the market average. So you have past, present, and future earnings. On the valuations front, 28 times forward earnings. Expensive, but not extreme. Certainly nothing like the 70x you saw in tech stocks coming out of the internet boom. On adoption, this is a little bit tricky. It's a lot of survey data in terms of who's adopting AI and who's not. But we hope to see an increase in business adoption, some of that stickier adoption. But so far, a number of businesses are reporting that they're using AI to produce their goods and services and operating with paid subscriptions. And then on the leverage point, you look at hyperscaler net leverage. It's about 0.8 relative to the average issuer in the investment grade space at about 2.6. So these companies are leveraging their cash. And when they are tapping the capital markets for debt, they still have it's smart capital allocation. They still have reasonable, sound balance sheets. So we still feel like those fundamentals will be intact for next year, driving that AI trade.
And there's, of course, the rest of the market, too. On the micro front, just today, you've got Nike lower on its results, FedEx impacted by cost pressures, KB Home citing downside risk for next year. So it seems like, outside of AI, there are certain situations that may be sounding the alarm into next year. Is that your read as you talk about the economic drift, as you call it?
As you look at S&P 500 returns and you start to see the pickup in the 493, it is still very much an AI story. It's just that AI story is broadening out to utilities, industrials, et cetera, a lot of the enablers of overall AI. Now, you have a counterweight in areas like financials that have still produced very impressive profits, could still benefit from things like deregulation, steepening yield curve, good macro environment. So if I'm thinking outside the AI trade, that's my favorite area when we think about those fundamentals. But again, we still have these looming issues in the background that when you look at margins in the S&P 500, areas like tech are skewing them higher. You look at the bottom end of the range when we think about margins, and some of those consumer sectors are still struggling. And that tariff impact, while it may not be a surge in terms of higher pricing and higher cost pressures, it's still going to feed into some of those sectors, and they have to be really smart about how they're appealing to consumers in a more K-shaped economy where that lower and middle income consumer is getting squeezed.